Welcome to Market Watch Daily. I'm TMI, bringing you the latest insights into global finance and market movements. Today, we are analyzing the significant stock market sell-off that occurred on March 6, 2025, and comparing it to historical market crashes to provide context and understanding. Today's market sell-off, March 6, 2025. On March 6, 2025, the U.S. stock market experienced a sharp decline, with the S&P 500 dropping 2.7%, marking its largest single-day loss since December. This downturn has brought the index closer to a correction, falling 8.6% from its peak just 3 weeks ago. Contributing factors. Several factors have contributed to this sell-off. Recession fears. Investors are increasingly concerned about a potential recession, driven by recent tariff policies and economic transitions described as a detox period. Tariff policies. President Trump's inconsistent stances on tariffs, including those affecting Canada and Mexico, have heightened market instability and raised fears of a prolonged trade war. Lack of intervention. Unlike previous market downturns, there is skepticism that President Trump or Federal Reserve Chair Jerome Powell will take measures to rescue the market, as indicated by Treasury Secretary Scott Bessent's comments. Historical comparisons. To better understand the current sell-off, let's compare it to notable historical market crashes. The Wall Street crash of 1929, known as Black Tuesday, this crash led to the Great Depression. The Dow Jones Industrial Average lost approximately 12% on October 28th, followed by an additional 11% loss on October 29th. Black Monday in 1987 on October 19th, 1987, global stock markets crashed, with the Dow Jones Industrial Average plummeting 22.6% in a single day. This event raised questions about market mechanisms and led to the implementation of circuit breakers to prevent future occurrences. The dot-com bubble in 2000, the late 1990s, saw a surge in technology stock valuations, leading to a bubble that burst in 2000. The Nasdaq Composite lost 78% of its value from peak to trough, causing widespread economic repercussions. The financial crisis of 2008, triggered by the collapse of the housing bubble and financial institutions, global markets experienced severe declines. The S&P 500 fell approximately 57% from its 2007 peak to its 2009 trough. The COVID-19 pandemic in 2020. The rapid global spread of COVID-19 led to a swift market downturn. The S&P 500 dropped 34% from February to March 2020, but rebounded relatively quickly due to unprecedented fiscal and monetary interventions. Current market indicators. Several technical indicators suggest that the market may be overvalued. Shiller P/E ratio. This ratio compares stock prices to earnings over a 10-year period. Currently, it is at 37.7, close to levels seen before previous major downturns. Buffett indicator. This metric compares the stock market's total value to the overall economy. At a record 211%, it indicates that stocks are exceptionally expensive relative to the economy. Investor sentiment. Despite the sell-off, mentions of recession in S&P 500 companies' earnings calls are at their lowest since early 2018, suggesting that corporate leaders may not yet be alarmed. Conclusion. The March 6, 2025, sell-off reflects a confluence of factors, including recession fears, tariff policies, and technical indicators pointing to overvaluation. While historical comparisons provide context, each market downturn has unique catalysts and outcomes. Investors should remain vigilant, diversify portfolios, and consider long-term strategies to navigate potential volatility. Thank you for joining us on Market Watch Daily. Stay tuned for more updates on global financial news and market movements.